Imagine the global economy for a second. It's this massive, immensely complex machine. A machine that literally powers our jobs, drives our industries, and ultimately protects our wealth and human prosperity. But who's actually standing in the control room? How do they keep the whole thing from overheating or just freezing to a complete halt? Well, let's get right into today's explainer, where we're going to break down the highly engineered architecture of economic stability.
So, who actually controls the value of the money in your pocket? I mean, it's not a trick question, but it's one we rarely stop to actually think about, right? We tap our cards, we hand over cash, but the actual purchasing power of that money, like whether your 50 bucks buys a whole cart of groceries or just a few snacks, is actively managed behind the scenes. This isn't just some abstract macroeconomic theory. This is about your daily life, your wallet, and for sure, your future. Here is the blueprint of the economic machine we are breaking down today. We'll start with managing the modern money supply, then open up the central bank toolkit. Next, we'll hit the highway of liquidity, navigate the hazards of inflation, deflation, and stagflation, and wrap up with the shield of independence. Okay, let's dive into this. Section 1. Managing the modern money supply, from passive to active control. To really figure out where we are today, we kind of have to look at how dramatically money has evolved. Historically, money was just a passive medium. Because it was physically anchored to precious metals, gold or silver, there was a hard limit on it. Governments and regular folks were basically just spectators to these natural and, honestly, often brutal boom and bust cycles. But then, in the 20th century, we shifted to fiat systems. Money became an active instrument. It's no longer tied to a shiny metal. Instead, it's actively managed by central banks using what we call monetary policy. They use it to proactively guide the value of our currency and smooth out the rhythm of our economic lives. They're no longer spectators. They are actively steering the ship. So what does that steering wheel actually look like? Let's move to Section 2, the central bank toolkit, the dashboard levers. Monetary policy relies on this core idea. The supply and cost of money influence literally every single aspect of economic activity. Central bankers have three main tools for this: interest rates, open market operations, and reserve requirements. But here's an absolutely crucial thing to keep in mind. They don't work instantly. They operate with time lags. Pulling a lever today might take months or even years to fully ripple through the economy. Let's break down the most visible tool on that dashboard: interest rates. Think of this as the cost of renting money. When a central bank raises rates, borrowing becomes expensive for everyone, from massive corporations to a family getting a mortgage. That cools down an overheated economy and slows rising prices. On the flip side, lowering rates is like turning up the thermostat in a freezing cold room. Borrowing gets cheap, which stimulates businesses to invest and consumers to spend, heating up economic growth. The other two tools are a bit more behind the scenes, but they're incredibly powerful. Open market operations simply means the central bank is buying or selling government bonds to directly pump cash into or pull cash out of the banking system. And reserve requirements? Those are the strict rules dictating exactly how much physical cash banks must keep locked in their vaults versus what they're allowed to lend out. Tweaking either of these literally alters the physical supply of money out there circulating in the real world. Now, what's really interesting about this next part is, well, it fundamentally changes how most people think about our financial system. Section 3, the highway of liquidity, moving the money. Liquidity is defined as the ease with which money can be converted into actual spending power. And this is entirely distinct from the total quantity of money that just exists. You can have a system absolutely flush with trillions of dollars, but if businesses and consumers can't easily access and spend it, the whole economy just grinds to a halt. Money supply and liquidity are really the twin lifebloods of our modern world. I absolutely love this metaphor. Vehicles are the money supply, road conditions are liquidity. Think about it. Too many cars on the highway, you get a massive traffic jam. That's inflation. Too few cars and commerce just stalls out. But the real kicker is this. Even if you have the perfect number of cars, if the road conditions are terrible, filled with potholes or completely frozen over, the value simply cannot flow. And, well, we saw exactly what a frozen highway looks like not too long ago. During the 2008 global financial crisis, we hit a massive liquidity freeze. Banks were completely terrified to lend to anyone, even to each other. The roads basically iced over. To prevent a total systemic collapse, central banks had to act as an emergency road crew. They injected massive amounts of cash into the system, using a highly specialized strategy called quantitative easing, just to thaw the roads and get those cars moving again.
Let's move on and see how this builds into the specific weather conditions central banks are constantly battling. Section 4. Inflation, deflation, and stagflation, hazards on the road. A central bank's success is pretty much defined by how well it navigates three specific value hazards. First up, inflation. This happens when the money supply grows faster than our ability to actually produce goods. More dollars chasing the same amount of stuff means prices rise and your purchasing power drops. Then you have deflation, a sustained decline in prices. Now, cheaper stuff sounds awesome at first, right? But wait, if you know a new TV is going to be 20% cheaper next month, you wait. We all wait. Consumers stop buying, businesses stop producing, and ultimately they start laying people off. It's a really dangerous downward spiral. Finally, stagflation. This is the absolute worst-case scenario. You have high inflation eating your wallet, combined with a stagnant economy and high unemployment. Ouch. And listen, these hazards aren't just academic theories. They are lived realities that demanded massive central bank intervention. In 1923, German hyperinflation was so severe, people literally used wheelbarrows of cash just to buy a loaf of bread. The currency became completely worthless. In the 1970s, the oil crisis triggered severe stagflation worldwide, forcing aggressive interest rate hikes to finally break the fever. And in 2008, as we just talked about, that liquidity freeze threatened to pull the entire global financial system into the abyss. Central banks are the ones out there fighting these historical fires. This brings us to a really fascinating structural question about how we organize this whole machine. Section 5, the Shield of Independence, the professional referee. Ask yourself this: if managing the money supply is so incredibly critical to human prosperity, why separate it from politics? Why shouldn't the elected officials that we actually vote into office be the ones sitting at the dashboard, directly pulling the levers on interest rates? The answer lies in a concept called time inconsistency. And look, this isn't a critique of any specific political party or politician. It's just a simple structural reality of elections. Governments naturally have overwhelming political incentives to print money or dramatically lower interest rates right before an election to get a short-term boost. The economy suddenly feels great. But structurally, this artificially pumps the system and inevitably causes severe long-term inflation and instability down the road. To protect the value of our money from that short-term political temptation, societies created the concept of central bank independence. An independent central bank acts exactly like a professional referee in a sports match. That referee has to impartially enforce the rules, even if the home crowd is screaming at them, and even if the teams on the field want a completely different short-term outcome. By placing a shield of independence around monetary policy, we ensure decisions are based on long-term stability, not just the next election cycle. And this brilliant architecture illustrates the absolute most fundamental truth of our modern economy. Money is, above all else, trust. Since we moved off the gold standard, the value of the bills in your pocket relies entirely on your trust in this system. It's the careful, disciplined management of those dashboard tools, the constant maintenance of the highway of liquidity, and the strict protection of institutional independence that actually holds this trust together. That is what maintains our prosperity. Which leaves us with a really critical question to ponder. The machine is always running, and the weather on the economic highway is constantly changing. Knowing what you know now about the tools at their disposal, the delicate balance of liquidity, and the absolute necessity of their independence, how will central banks steer our economic machine through the next unprecedented global crisis? It's a fascinating question, and one that directly impacts all of our futures. Thanks for joining me for today's Explainer. I hope it brought some real clarity to the incredibly complex engine that drives our world.